Hi everyone. In this video, I'm revealing the SPY Volume Reverter Strategy, a systematic approach that trades the Spider S&P 500 ETF that's delivered a solid 41% exposure-adjusted return over 21 years with only one down year so far. Stay tuned because I'm sharing the exact entry and exit rules with zero guesswork. This strategy trades SPY on a daily time frame and only takes long positions. We'll cover the specific rules shortly. I've put together a comprehensive strategy guide you can download completely free. The link is in the description below. Before we look at the rules, let's check out the backtest results. We tested this strategy from January 2nd, 2004 to January 31st, 2025. That's 21 years of data. Here are the key stats. We have a total return of 4.4x, an annualized rate of return of 8.3% over the last 21 years. And over the last 5 years, we have an annualized rate of return of 9.4%. We have a Sharpe ratio of 0.86, a maximum drawdown of 15.7%, the maximum peak to trough decline over this entire backtest period. A MAR ratio, which is our rate of return divided by our maximum drawdown of 0.53, an average exposure of only 20.3%, an exposure adjusted return of 41.1%. This strategy has taken a total of 221 trades over this backtest period with an expectancy or average trade return of 0.8%, with a profit factor of 1.55, a 62.9% win rate, a 2.3% average win, and a 1.7% average loss, with an average win length of 5 days and an average loss length of 5 days as well. This is the equity curve of the strategy. You notice that it is generally trending upwards with a few flat or slightly declining periods, but the drawdowns are mild and relatively short-lived. This table presents yearly and monthly percentage returns along with total annual returns and annual maximum drawdowns. Here are the key takeaways. The highest annual return was in 2008 with a 40.6% return, which is a very strong performance during a year when the market was very negative due to the global financial crisis. The worst annual return was in 2023 with minus 1.7%. You notice that this strategy has only one down year in the 21 completed years. We have a maximum drawdown of 15.7%. This represents the largest peak to trough decline during the backtest period, and this happened in 2009. Let's dive into the entry rules. We enter long when the volume is lower than the 5-day average volume and the current price is the lowest close in the past 5 days. In essence, we are trying to capture a low volume pullback in the market. Next, we need to know when to exit. We have a profit target of 2.5x the 14-day ATR above the entry price and a time-based exit of 5 bars if the target isn't hit. For a realistic backtest, we have included transaction costs of a commission of the higher of $1 or 0.5 cents per share, which is the default Interactive Brokers commission. For all our strategies, we also include a slippage of 1 tick for stop orders, but as there are no stop orders in this strategy, it is not relevant in this case. These transaction cost assumptions help ensure our results are closer to what you'd experience in live trading. Now let's take a look at what some of the entries and exits look like based on these rules. You can see how the strategy aims to enter based on specific low volume and low price conditions and manages trades with its profit-taking and time-based exit rules. This is a take profit example. In this example, when the volume is lower than the 5-day average volume and the close is the lowest close in 5 days, we go long on the next open. The price moves up and hits the profit target for a gain of 4.4%. This example trade shows an exit based on the time stop. After entry, the profit target isn't reached within 5 bars, and we close the position on the next open, resulting in a 1.53% loss. So what's next? We're moving into forward testing, tracking live market performance to see how the SPY Volume Reverter strategy holds up. We'll be updating the performance of this strategy on a monthly basis. If you want to follow along, make sure to subscribe. While an 8.3% annual return might not sound revolutionary on its own, this strategy is designed as a building block in our Holy Grail portfolio. When combined with other low correlation strategies we'll be revealing in upcoming videos, we're targeting double the annual returns of the S&P 500 with less than half the maximum drawdown and a smoother equity curve that lets you sleep well at night. This is just one piece of what I call the Holy Grail portfolio, a collection of strategies that work together to deliver what individual approaches cannot. If you found this video valuable and want to follow along, do these three things: download the complete strategy guide using the link in the description, subscribe and hit the notification bell to catch our new strategy reviews and monthly performance updates, and share your thoughts in the comments. I personally read and respond to everyone. For those who want to go deeper, I'm sharing exclusive strategies through my newsletter at grailwealth.com, and you can connect with me directly on X at grailwealth. See you in the next video where we'll be finally putting together the first version of our Holy Grail portfolio. Until then, happy trading.